Welcome to Portfolio Cast, the podcast where we break down real investor portfolios using publicly available data.
In this episode, we're analyzing Prem Watsa from Fairfax Financial Holdings, based on their latest reported 13F filing, exploring the key holdings, portfolio concentration, and what the positioning might tell us about their thinking.
In 2008, while the global financial system was melting down, Prem Watsa was printing billions. They call him the Warren Buffett of Canada. But his latest moves suggest he's not just looking for value, he's building a fortress against a very specific kind of future. With nearly 30% of his $2.6 billion portfolio locked into a single mining play, Watsa isn't just investing, he's placing a massive bet on the physical world.
It's a bold stance, Sarah. While most of the market is obsessed with AI and software margins, Watsa is leaning into what we're calling industrial conviction. He's up 23.8% overall on this portfolio, and he's doing it by zigging where the S&P 500 zags. He isn't just a contrarian, he's a specialist in the tangible.
That conviction is most visible in ORLA mining. He has over $1 billion, specifically $1,573,688,631 sitting in this one company. That is 29.6% of his entire reported equity portfolio. Most fund managers would lose sleep over a 5% allocation. Watsa is practically living in a mine.
It defies every standard rule of diversification. But look at the scorecard for ORLA mining through that lens of industrial conviction. Watsa is betting on the durability of the core mining operations and a high insider ownership that aligns with his owner-operator philosophy. Valuation: it's trading at a PE of 116.8, which looks pricey, but he's already sitting on a 73.3% overall gain. Momentum: technically, the stock is around 60.4% through its 52-week range, which reads as range-bound between $8.34 and $25.35. Risk: the massive concentration. If the gold cycle turns, the anchor of this portfolio becomes a lead weight.
And he's funding these bets by pulling away from the broad market. He recently reduced his position in VOO, the S&P 500 ETF, by over 20%. Even though VOO is in a clear technical uptrend, sitting near the very top of its 52-week range at $639.16, Watsa is saying no thanks to the index. He's trading the broad market for specific, old economy resurgence plays.
Exactly. He's replacing digital growth with what I call the physical world trifecta: gold, oil, and steel. Beyond the billion-dollar ORLA position, he's got $268 million in Occidental Petroleum and $208 million in Cleveland-Cliffs. This isn't a hedge, it's a thesis. He's betting that in an inflationary or volatile world, the person who owns the oil and the iron ore wins.
It's interesting to see the contrast. Occidental Petroleum is a 13.8% allocation, and even though he's down about 5.9% overall on that position, he hasn't budged. He's holding firm at 6 million shares. Positioning-wise, OXY is range-bound, sitting right in the middle of its 52-week context. He's waiting for the cycle to turn his way.
And Cleveland-Cliffs follows that same blueprint. It makes up 8.8% of the portfolio. Technically, it's showing a bit more strength, sitting at 75.6% of its 52-week range. By holding these alongside ORLA, he's built a portfolio that is essentially a bet on global infrastructure and raw materials.
But here's the open tension. Can a $2.6 billion portfolio actually survive this? When 30% of your net worth is tied to a junior miner like ORLA, you aren't just betting on a theme, you're betting on perfection in execution. If the physical world hits a snag, there is no safety net in this portfolio. Is the Buffett of the North seeing a supercycle we're all missing, or is he flying too close to the sun? We've spent years watching Prem Watsa play the long game with tech turnarounds, but the data tells us the weather is changing. We're entering a phase of contrarian resilience, where Watsa is willing to let go of the digital dream to protect the house. This isn't just about finding value. It's about a great rotation out of speculative what-ifs and into the tangible world of ketchup, beer, and oil rigs.
You can see that resilience being tested right now with BlackBerry. Watsa finally trimmed that position by 13%. After holding through a decade of pivots, he still has $134 million on the table, about 8.3% of the portfolio, but that reduction is a massive signal.
Is he losing patience? Or is the Warren Buffett of Canada finally admitting that even a decade might not be long enough for a turnaround to catch fire?
If we look at the scorecard for BlackBerry, the tension is clear. On Moat, the business has to keep its footing in cybersecurity, but it's struggling. Valuation is sitting at a PE of 102.9, which is a lot to pay for a company that is technically in a deep downtrend, sitting right at its 52-week low. The momentum is non-existent, and the risk is that the fundamentals continue to deteriorate while the rest of the market moves on.
And while he's trimming the tech legacy, he's beefing up the defensive fortress. He added nearly 5% to Kraft Heinz and almost 6% to Molson Coors. This is the definition of contrarian resilience, buying the brands that people consume whether the economy is booming or breaking.
Exactly. He's looking for that margin of safety in dividends. Kraft Heinz is yielding a massive 6.79% right now. Positioning-wise, Kraft Heinz is in a downtrend, nearly 30% off its 52-week high, but Watsa is using that weakness to build a $121 million position. Compare that to Molson Coors, which is more range-bound. He's essentially getting paid a 3.8% dividend yield to wait for the market to realize that people still drink beer in a recession.
It's a pivot toward cash flow. But there's a massive mystery in this portfolio: CVS Health. It's nearly 10% of his total $2.6 billion holdings, and the numbers are jarring. Mike, why hold $203 million in a company with a 225 PD ratio while the headlines are screaming about Medicare Advantage headwinds?
It looks like a classic Watsa buy the fear move. CVS took a 10.4% hit today alone, but he hasn't budged. On the scorecard for CVS, the mode is their integrated pharmacy and insurance model, which he clearly believes is durable. Valuation looks sky high at that 225 PE, but the risk is balanced by a 3.17% dividend yield. Technically, CVS is range-bound, sitting about 11% below its 52-week high, but it hasn't collapsed like the junior miners he's also betting on.
That brings us to the tactical muscle. He didn't just buy ketchup. He increased his stake in Helmerich & Payne by 20%. That's a $38 million bet on energy services infrastructure.
And that's the one area where he actually has the wind at his back. Positioning-wise, Helmerich & Payne is in a clear uptrend, hitting nearly 90% of its 52-week range. It's the physical world thesis in action oil and steel supporting the portfolio while the consumer staples provide the floor.
So, let's answer the big question we opened with. Can this $2.6 billion portfolio survive such extreme concentration in the physical world? Watsa is currently sitting on an overall gain of 23.8%. While the market chases AI, he's built a fortress out of gold, oil, and consumer staples.
He's moving from growth turnaround mode to defensive fortress mode. By trimming BlackBerry and adding to the likes of Kraft Heinz and Helmerich & Payne, he's signaling that the next cycle won't be won by bits and bytes, but by the companies that own the ground we walk on and the goods we can't live without.
It's a masterclass in patience. Whether it's waiting for a gold cycle to turn or for a 225 PE health giant to find its footing, Prem Watsa isn't playing for next quarter. He's betting that when the dust settles, the physical world will be the only thing left standing. That's it for this episode of the Portfolio Deep Dive. We'll see you at the next closing bell. Thanks for listening to Portfolio Casts.
This content is for educational purposes only and should not be considered financial or investment advice.
Any figures, prices, or portfolio values discussed are approximate, based on public filings, and used for illustrative purposes only.
The views expressed are interpretations of public information and may not reflect the investor's current positions.
Follow Portfolio Casts for more investor portfolio breakdowns.